India Inc. has closed the books on FY26. And going by the Q4 numbers, which is the January to March quarter, corporate India ended the year on a strong note. Profits rose sharply, revenues accelerated, and margins touched multi-year highs. So what does India Inc.'s final Q4 earnings scorecard look like? And can this performance continue into FY27? The combined adjusted net profit for 3,081 listed companies grew 15.1% year-on-year in Q4 FY26. That's a sharp improvement from 9.2% growth in the same quarter a year ago. In absolute terms, profits climbed to around 4.74 trillion rupees compared to 4.12 trillion rupees a year earlier. This was the third consecutive quarter of double-digit profit growth. Also, revenue growth broke out of a prolonged slump. Combined net sales rose 11.4% year-on-year, the fastest pace in 12 quarters. The biggest boost did not come from the usual heavyweight sectors. Instead, earnings growth was led by public sector oil marketing companies, non-bank lenders, metals and mining firms, and power utilities. Meanwhile, sectors such as banking, IT services, automobiles, FMCG, and capital goods posted relatively slower profit growth. Among individual companies, Indian Oil Corporation emerged as the largest contributor, accounting for 10.2% of total earnings growth. LIC added 7.1%, ONGC contributed 5.9%, NTPC 4.6%, and IndusInd Bank 4.4%. Together, these five companies accounted for nearly one-third of India Inc.'s total earnings growth in the quarter. On the flip side, heavyweights like Reliance Industries, Tata Motors Passenger Vehicles Division, and Interglobe Aviation pulled overall earnings lower. Perhaps the most important takeaway from the quarter was profitability. India Inc.'s adjusted net profit margin hit 11.3%, the highest in at least 21 quarters. 5 years ago, profit margins were just 8.6%. The answer lies in costs. Many companies benefited from lower interest expenses and tighter control over employee costs. Salaries and wages rose just 6.4% year-on-year. Overheads increased just 3.6%. Interest expenses for BFSI companies rose just 2.2%, while their income grew 7.1%. For non-BFSI companies, interest costs grew 3.1%, while revenues jumped 12.8%. This pushed overall profit before tax margins to a record 13.6% of total income. But analysts are quick to temper the enthusiasm. They say a large part of the earnings strength came from cyclical industries and one-off factors. Commodity inflation boosted revenues, the rupee's depreciation supported earnings in several sectors, and some sectors were still benefiting from the after effects of earlier GST rate cuts. So the quarter got an extra boost that may not repeat. According to analysts at Systematics Institutional Equity, these factors make year-on-year comparisons unusually favorable. But the next few quarters may not be as smooth. Since March, new headwinds have emerged. With commodity inflation rising, fuel prices surging, and bond yields climbing, analysts warn that these pressures could erode the margin gains seen in Q4. The full impact of the war in West Asia on corporate earnings is not yet priced in. JP Morgan revised FY27 estimates down by 2 to 10% across the consumer, auto, and financial sectors. So while Q4 FY26 was one of the strongest quarters India Inc. has delivered in years, with double-digit profit growth, double-digit revenue growth, and record margins, the bigger question is what comes next. Can corporate India sustain this momentum, or will Q4 FY26 prove to be an exceptional quarter that's difficult to repeat? Follow Business Standard for more such stories.